David, you have to unmute yourself. One second here.
Sorry, I'm muted. Are we ready now?
We are ready.
Okay, thank you so much. I want to welcome, hi, I'm David Mandy, president of O&M Partners, and I want to welcome everyone today to the Seabridge Gold Town Hall call. It's a real pleasure to have everyone on us. With us, I'm David Mandy, a president of O&M Partners. Just give me 1 second here. I'm so sorry. I've got Thank you very much. So Seabridge trades on the New York Stock Exchange under the symbol SA, and they also have a TSX listing under the symbol SEA. We want this broadcast to answer all of your questions. Questions can be easily answered by going to the question portal of GoToWebinar, or you can also email us. We promise that all questions that are unanswered will be we'll follow up with you in a very timely manner. Before we turn to our host of the call today, we're very pleased to have Jim Anthony, who's actually a host as well. He's the co-founder of Seabridge Gold, here to talk to us kind of big picture. Jim has advised a number of major corporations and venture capitalists focusing primarily on corporate strategy. He was a policy consultant for several government ministries as well. He was there with Rudy in 1999 when they started Seabridge. He's Jim, and why really pleased to have him today is he's a keen student of economics. His analysis of financial markets actually contributed to forming Seabridge's unique corporate strategy, which highlights his maximum leverage to a rising gold price. Mr. Anthony's commentaries in the company's quarterly reports correctly anticipated the nature of the current economic crisis years in advance, predicted a powerful long-term bull market in gold, marked by its transition from a commodity to the world's preferred currency. It's a real pleasure to turn the call over to Jim.
Thanks very much, David. If we can just bring the slides up, Rudy.
Yeah, I thought I did. Are the slides not up?
I can see them. Jim, can you not see them?
No.
Yeah, I can see them as well.
Okay.
Jim, go make sure that you're, click on the control panel itself, and up at the top you should see window. Maybe go now viewing Rudy Frank's screen. Do you see
Actually,
that?
I can do it from my own set of slides here, so no problem. Let's get underway.
Okay, Jim, just tell me when to advance the slides so everybody can see them.
Not a problem. So, you know, the debate that's going on right now in the gold community and in the much wider investment community is inflation or deflation. Gold does well in both, but better in inflation, and we see inflation in our future. You know, this is not 2008, it's not the Great Recession, and what the Fed did then and what it's doing now are really two different things. Then it started quantitative easing, and most people thought that was going to generate inflation, but it didn't. It didn't generate a major increase in money supply. It didn't generate inflation because the Fed actually quite cleverly did two things to prevent it. They introduced interest on excess reserves, IOER, and much higher bank reserve requirements that in effect corralled the quantitative easing in the financial system. And in effect, the Fed created a slush fund to buy the bonds the Treasury was selling. So the primary dealers bought the bonds from Treasury. They'd hold them for a few days, and then they'd sell them to the Fed. The money for all of that was provided by the increase in reserve requirements on the primary dealers and other banks. And they were induced to be happy with that by getting interest on their reserves that they never had before. And so it was a rinse and repeat business. with basically a circular flow of money that did not leak into the economy and did not generate inflation. Well, that's not what's happening this time around. This time, Fed money is flowing directly, mainlining into the economy by funding Treasury payments to individuals and businesses. All you need is an account with the IRS and they can send you money. This is helicopter money. This is different. Slide. So if we look at the stimulus this time around, it's much bigger and it's much faster than what happened during the Great Recession. It's especially faster. The Fed implemented its total program of quantitative easing and a whole alphabet of acronyms of different funds that they set up, and it took them months to do it from 2008 onward. This time around, they did the whole shebang in 8 days earlier this year, March. Treasury is now spending twice what they take in tax revenues, which is just amazing. The 2020 budget deficit that ends in October, currently estimated at $2.6 trillion if we do not get a further stimulus, which we may, depending on whether or not Madam Pelosi will go along. 57% of Treasury expenditures are financed by the Fed. This is really without precedent. It really is the monetization of debt. So interest on excess reserves have been reduced. The reserve requirements have been loosened. There is no longer a corral around the Fed new money creation. So money supply is now soaring, and we'll show you that in a sec. And as the money supply rebounds, we're also seeing that demand for cash hoarding is reducing, as you would expect it would. The biggest shock of the coronavirus and its impact on the economy has come and gone. Money will be spent now that would have been hoarded in March, and it's being spent into an economy where we increasingly see supply chain failures and business failures, which have reduced the supply of goods and services. So that also is, in our view, inflationary. Next slide. So here we have a lovely chart of MZM money stock. That's the narrowest measure of money supply. It's the money that's immediately available for purchasing goods and services. And you can see that it's just quietly going off the charts here. It's unprecedented. It's growing at over 30% year over year. We've never seen this before. So the Fed is intending to create inflation. Slide, please. And can it do so? Yes, we think it can. We think you shouldn't fight the Fed. Key rules, just to review, have been changed to push new money into the real economy, not just financial assets. The new stimulus is way beyond quantitative easing as it was back in 2008 through 2014, both in its amount and the type of it. The Treasury is borrowing from the Fed to pay people not to work and businesses not to produce. This is true debasement of the currency, not just quantitative easing as it was back in the 2008 to 2014 period, which we could properly call credit inflation. The Fed balance sheet is degenerating rapidly into what we laughingly call a payday lender without a payday. And yes, the quality of the Fed's balance sheet does affect the value of its liabilities, those liabilities being dollars. If you look at the history of the Fed balance sheet, it began in 1913 with that balance sheet consisting entirely of gold, about 94%, and about 6% 90-day commercial bills. Very solid. Over time, as it has changed the makeup of the balance sheet to reflect almost entirely, over 90%, treasuries, the quality of its balance sheet has declined, and so have its liabilities. The dollar has gone down. Now, we're in a more extreme situation even than that, where the Fed is buying corporate debt, including high yield debt, stuff that probably you and I would never consider putting on our balance sheet. And they're doing that in order to stimulate the economy, but they are, again, further weakening their balance sheet, which we believe will further weaken the dollar. So bottom line, we are calling for stagflation, a return to the 70s, and a much higher gold price similar to what we saw in the 70s. Next slide, please. So we predict $2,500 gold within 6 months. Now, we're on record as having predicted $2,000 gold this year. We got that target. We think that we can see $2,500 ahead for the gold price. But we should also recognize there will be corrections along the way. We are quite possibly having such a correction now. The metal is overbought. The sentiment indices are pretty high, unreasonably high. So in fact, we're getting, we believe, a sideways correction in the gold price, short-term and temporary, but that's not going to last. The dollar is oversold, so we could expect a bounce from that, which probably is a headwind for gold, but the trend is down. And if you look back at the previous slide, really, if we can just pop back to the US dollar slide, you can see how the dollar spiked after the coronavirus started to impact the economy in expectation of a deflationary event. But it's been just about straight down since then, from a high of over 103 to now down to around 92, which indicates, in our view, the inflationary environment to come, not a deflationary one. And so going back to why we predict gold at $2,500, the gold stocks are going to run with gold. They haven't been keeping pace with the metal up till now, but we expect that to change as they begin to report pretty astounding profits. It's interesting to note that Barrick is trading at 12 times earnings, and well, let's say Netflix, it's at 84 times earnings. That's a teeter-totter that's going to tilt the other way as people chase higher earnings yields, which is something the market has tended to do. The gold stocks are going to look increasingly interesting. They are cheap, and if you look at Apple, its market cap is 2.5 times the entire gold industry. We don't think that's going to continue. Anyway, that's my quick review. David, back to you.
Thanks so much, Jim. Again, that's Jim Anthony. He's the co-founder of Seabridge. Now we're going to turn to Rudy Franck. Rudy is the chairman and the chief executive officer. It's always a pleasure to introduce Rudy. He's got over 35 years of experience in the gold business. He was trained as a mining engineer. He has broad experience in the industry. He's been involved in every stage of project development. But Seabridge is his baby. He started this in 1999. That's 20 years. It's a long commitment, and it was not a, it was a rough ride in terms of with the gold price. But Rudy's been playing the long game. He has successfully created the best leverage play to rising gold prices, which was always the goal. Well, most people were spending money to buy gold or selling gold. Rudy was buying gold. Seabridge has more gold per common share than any company in the industry. He also has more copper than most copper companies. We've worked with Rudy since 2006, can attest to the fact that this story is always developing. The team always has news to report, and they've never stopped creating value for their shareholders. And on that note, I'll turn the call over to Rudy.
Thanks, David, and thanks, Jim. Just a reminder, obviously, our forward-looking statement of the gold price at 2,500 is a forward-looking statement, and I will also be making forward-looking statements throughout my portion of the presentation. So why Seabridge? Well, in terms of reserves, between KSM and Courageous Lake, over 45 million ounces of proven and probable gold reserves, plus 10 billion pounds of copper, and that's contained within an overall resource of 123 million ounces of gold and 46 billion pounds of copper. I think what we're proud of most is our ability to manage our capital structure. One of the biggest risks you face in investing in junior gold companies or exploration companies is the risk of equity dilution. It always amazes me how quickly companies can go to hundreds of millions of shares outstanding before they report any type of resource numbers or create any value that's tangible. 21 years later, we only have 66 million shares outstanding, and no, we've never done a rollback. Today, we're trading at less than $30 per reserve ounce or less than $10 per resource ounce. In mine and Jim's career, we've actually had mines that we have built expropriated. Political risk is real. When we formed Seabridge in 1999, we've made the decision to only focus on opportunities in North America. I think what we've done best as a company is finding gold. If you look at our track record over the past 15 years, we've found more gold through our exploration activities than any other gold company on the planet, and that does include the majors. We also take advantage of down markets and tend to do our acquisitions when valuations are low, being able to buy things on the cheap. And then at market highs, we tend to sell non-core assets as a way of funding future work on the assets we do want to spend on. And I'll touch briefly today on 3 new acquisitions we now have that we're working on. So this is a slide that most CEOs of gold companies won't show you. When Jim and I formed Seabridge in 1999, our prime objective was to create what we thought would be the best leverage play to a rising gold price. Back then, gold was trading at about $260 an ounce, and we believed it would go substantially higher over time, which obviously it has. Our mission was to build a company that provided more gold ownership per common share than any other company on the planet. And we've now delivered on that. Everything we do from exploration and acquisition is geared towards growing ounces per share. We finished our first wave of acquisitions in 2002, where we had acquired 15 million ounces from larger companies. And by the time we finished those acquisitions, we had 27 million shares outstanding. So about a half an ounce of gold per common share. If you fast forward to 2019, by the end of 2019, our share count had grown from the 27 million when we finished the first wave to 63 million shares outstanding at the end of 2019. But our ounce count went from the 15 million ounces we acquired to 123 million ounces, meaning that each one of our shares was backed by almost 2 ounces of gold per common share. That's 15 to 20 times more gold ownership than any other company on our planet. And this does not yet include the 600 million ounces of silver we also have as resources, nor the 46 billion pounds of copper. And what that has translated into is exactly what we were hoping it was, and that's significant outperformance relative to gold and other gold equities. In fact, over the past 21 years, on average, our share price has outperformed the gold price by about 10 to 1. Gold is up almost just over 500%. Our share price is up over 6,000%. And then if you look at those periods of time when gold is really strong, like from 2004 to 2007, and then again coming out of the financial crisis to 2010, our shares really outperformed on a relative basis. Gold hit bottom recently in 2015 at about 1,050. Since that time, our share price is up almost 500%. What I'll touch on mostly today is what's new, namely the technical report we just filed on KSM, which shows a much improved project as a result of adding iron cap to the mine plan. Also talk briefly on the acquisition we completed recently at the height of COVID, acquiring 100% of the 3 Aces project in the Yukon, and then also touch briefly in terms of the 2 drill programs we now have underway, one at Iskut and one at Snowstorm. KSM is the project that just keeps on giving to us. We bought this project in June of 2000 from Placer Dome. Placer Dome had spent about $25 million at KSM, finding 2 deposits where they calculated a resource of 3.4 million ounces of gold and 2.7 billion pounds of copper. If you fast forward to today, we've now spent over $300 million at KSM, defining today what is the largest gold copper project in the world as measured by gold reserves. This project is located in the Golden Triangle that's now seeing a lot of activity, not only by juniors, but also with the majors coming in now, with Newmont there, Teck there, and Newcrest all having interest and projects in and around KSM. We've not only completed a lot of exploration here, growing the project ounces significantly, but we've also taken this project successfully through the environmental assessment process. This is one of the few large-scale projects in the world today that is truly shovel-ready. And to get where we got to today, we also spent a lot of time on establishing our social license. We now have impact benefit agreements in place with both the Nisga'a Nation and the Tahltan Nation, as well as ongoing and continuing support from other Indigenous groups in the area, as well as the local communities. One big change for us that happened with other people's money is the new infrastructure that's been put in place now that will significantly help KSM. We have now a major highway just to the east of the project, Highway 37. Along that highway, the government has now extended the power grid, spending over $700 million to bring low-cost hydropower to the district. We've now secured, with contractual arrangements with BC Hydro, 250 megawatts of power off that line that we'll be able to buy for about 5 cents per kilowatt hour. And then last but not least, just to the south of us in the town of Stewart, we have an old port that was now been significantly upgraded, as well as a brand new port that was recently built. This will allow us to bring supplies in on an annual basis and also take the concentrate out to hungry smelters on the Pacific Rim. I can't tell you how significant it is to have highways, ports, and power close by that we don't have to build as part of project development. We finished our first pre-feasibility study in 2012. It was that study that was used to obtain our permits. We did receive project approval in late 2014. In 2016, we decided to update the pre-feas to show the impact of the commitments we made during the environmental assessment process, as well as to show the changing economics as a result of changing metal prices and foreign exchange estimates. That updated study captured 2.2 billion tons of reserves, containing 38.8 million ounces of gold and just over 10 billion pounds of copper. And when you looked at the economics of the study, the all-in cost of production, including all of the upfront capital, the sustaining capital, the closure costs, and the operating costs, net of copper and silver credits, was about $670 per ounce. So at today's gold price, quite a healthy profit margin. What that feasibility study did not yet include, however, are the two new areas that we added subsequent. The Deep Kerr Zone, which was found in 2013, and now more recently the Iron Cap Zone. We now have another 44 million ounces of gold and 29.3 billion pounds of copper to play with in our mine plans. When you look at KSM, we are blessed with just a significant amount of economic resources that have either been constrained by open pit shapes or by block cave shapes. In fact, we have 7.6 billion tons of resources that now host about 107 million ounces of gold and 46 billion pounds of copper in all resource categories. When we went through the environmental assessment, we've now permitted for 2.4 billion tons of tailings in a single tailings location. So although we have 7.6 billion tons of available resources to play with, we have been focusing on what is the best 2.4 billion tons that we can mine to drive the best economics for the project. We just submitted a new mine plan in an updated technical report that was filed a couple of months ago. This new mine plan captures material from all four of our deposits, starting first at an open pit at Mitchell, then going to a block cave at Iron Cap, then to an open pit and a block cave at Kerr, and finally to an open pit at Sulphurets. This updated mine plan, again limiting ourselves to only 2.4 billion tons, now captures 40.4 million ounces of gold, compared to the 38.8 million ounces we have in the reserve mine plan. But instead of 10.2 billion pounds of copper, we're now capturing 19.2 billion pounds of copper. And as you would expect, the additional copper that's captured in essentially the same size resource base adds a lot of positivity to the economics. This will be the largest mine ever built in Canada. Our initial design throughput is 170,000 tons a day. And even at that large throughput rate, we can still show a 44-year mine life on a project that's only capturing about a third of our resource. This project in the early years is more gold-centric, producing a lot more gold than copper on a revenue stream. And then as we bring the higher grade copper zones at Iron Cap and Deep Thur into the mix, we produce a lot more copper while gold production goes down. People ask us, why did you done all these different mine plans if you had such a good case in the beginning? Well, I think it's important to point out that as we continue to look and try to bring a partner to develop KSM, we want to be able to show the best project that we can in our negotiations with the large mining companies. So if you look apples to apples between the three different mine plans we've now put forward, our 2016 pre-feasibility case had an all-in cost of production of about $670 an ounce. When we did an updated study bringing in the Deep Thur deposit and not yet focusing on Iron Cap, the project improved with our all-in costs going from $670 down to about $350 an ounce. And now more recently with the updated study incorporating Iron Cap, we're able to now to show at the same metal price assumptions that were used in the 2016 mine plans of less than $100 per ounce. Those metal prices in those mine plans, however, are a lot lower than they are today. So we now can show a new base case with the 2020 mine plan, incorporating a 3-year metal price look back for gold, copper, and silver, as well as the US dollar Canadian exchange rate. We can now show a project where we produce enough copper and silver over the 44-year mine life to pay for all of the capital, initial capital, sustaining capital, the closure costs, the reclamation costs, and the operating costs. So at a $2.80 copper price, this project has an all-in cost of production per each ounce of gold produced of essentially zero. And obviously, as you would expect, as metal prices go higher, this project also has tremendous leverage to both gold and copper prices at higher levels. One other thing I'd like to point out is the concept of capital efficiency. On a project that goes for 44 years plus the construction period, anything in an internal rate of return calculation beyond year 20 really isn't captured in project value. However, my experience in the business, which is now 38 years, suggests that a very important metric that big companies look at is the concept of payback period relative to mine life. This is a project that can now show a payback period in less than 10% of its project life. A 44-year mine life relative to a 3 to 2 year payback. That is quite remarkable. We're not a single asset company. Another large asset we have in the portfolio is Courageous Lake, an asset we acquired from Newmont and Total Energy in 2002. We did finish a pre-feasibility study on Courageous Lake in 2012 that showed a fairly marginal project back then. A big part of that was a very strong Canadian dollar relative to the US dollar, which is not a benefit to Canadian assets. However, if you take those same set of numbers and just change the exchange rate as well as the gold price to where they stood recently, you see a project that was uneconomic in 2012 looking very, very different today. Last year, we also did a further study at Courageous Lake looking within this larger project, is there a smaller, less capital intensive project that provides more robust economics? And we did that work with 2 independent consultants and came to the conclusion that yes, there is a smaller project here that can be built. We are now assessing what is the best path forward with Courageous Lake to unlock value to our shareholders. What we're considering is perhaps an outright sale, perhaps a joint venture, or perhaps continuing work on it ourselves. And this will play out over the next few months. What I will point out, though, is that there has been a lot of indications in terms of the market dynamics today on similar projects that have been sold or could generate hundreds of millions of dollars of value back to us that is not being captured in our market cap today. Our most recent acquisition is the Three Aces project in the Yukon, a project we acquired from Golden Predator, struck our deal right at the beginning of COVID and closed the deal in May. To buy this asset, we gave Golden Predator 300,000 shares and a 0.5% royalty. Plus, we agreed to make conditional future payments to them if we are successful on finding more gold. We hope we have to write those checks within the next few years. Calling this a project really does not do it justice. We really acquired a district here. We have about 350 square kilometers comprising Three Aces, 35 kilometers of strike length that has known gold showings up and down the entire strike length. This project also has a road right to the front door, so we're able to bring supplies in, drills in, without having to fly them in. We also have a 25-man exploration camp that came along with the acquisition. Another positive of this project is the work that Predator Gold did in securing good working relationships with the First Nations. We will step into their shoes on that and be as successful here as we have been at KSM in the past. Why we did this? Well, take a look at these numbers. As you can see here on drilling that was done in 2016 and 2017, very, very high grade intercepts were hit very, very close to surface over significant widths. Some of these intercepts here are pushing 3 ounces of gold per ton. We believe that these veins have down dip potential as well, which was not yet tested. And also when you look at the drilling that's been done to date, the gold mineralization isn't confined to just the veins. There's also a halo of lower grade gold outside the veins, which suggests that this actually could be a large bulk mineable open pit system. We are now in the process of assembling all the data that's been historically generated for this project, with the hopes that we'll be able to conduct our first drill program at 3 Aces in 2021. An acquisition that we're now working on aggressively is what we acquired when we acquired Snip Gold in 2016, where we acquired the Iskut property that initially gave us 2.2 million ounces of gold in the measured and indicated category and about 500 million pounds of copper. As we've studied this project, we are amazed with the similarities we see to KSM. The project is located only about 30 kilometers as the crow flies. We've done a fair bit of work over the past few years to try and vector in what is the best meaningful target that we can go after, and we are now in the process of drilling what we believe could be a large gold copper porphyry system. When you look at the age of mineralization, the structural elements that control the mineralization at KSM and are evident at Iskut, as well as the rocks, the similarities between Iskut and KSM are quite exciting. Our third exploration project in the portfolio is Snowstorm, a project we acquired from John Paulson for common shares and some common share purchase warrants in 2017. I can't think of a better address to have for a gold exploration project. Snowstorm sits on the intersection of the Getchell Trend, the Northern Nevada Rift Trend, and the Carlin Trend, which are probably the 3 most prolific gold belts in the world that are being mined today. And just north of Twin Creeks and Turquoise Ridge, which are 2 of the larger mines in the newly formed joint venture in Nevada between Newmont and Barrick. Last year, we did drilling at Snowstorm to confirm that the same elements that exist at Twin Creeks in terms of structures and alteration and rocks are evident at Snowstorm. We have now started our second exploration program at Snowstorm, hoping to vector into Twin Creeks and Turquoise Ridge style mineralization. These targets are small, but they're very, very high grade. In fact, the proven and probable reserves left at Turquoise Ridge are about 13 grams per ton, or almost 0.5 ounce per ton. That's the type of target we're going after at Snowstorm, so stay tuned on that. So if you own Seabridge shares, what's going to drive value? Well, first and foremost is the gold price. We have a 21-year track record of showing significant outperformance relative to gold and other gold equities. If gold is in now a higher moving market that we believe it is in, our shares should just do fine as gold moves to the next level. Exploration. Our team has found more gold over the past 15 years than any other company on the planet. In fact, our exploration team on programs on our projects has yielded in excess of 100 million ounces of gold in new discoveries over the past 15 years. We now have 3 new projects to play with, any one of which we believe can be a company maker. And then last but not least is a joint venture on KSM. We recognize that probably the most impactful thing that we can do for our shareholders is bringing a partner in that's willing to commit to take KSM to a construction and into production. We have dialogue going on with the 7 largest mining companies in the world today, both on the base metal side and the gold side. We need a big company to co-develop this project. Our goal in a joint venture is to hang on to a meaningful interest in the project while minimizing our capital contribution. We have received proposals in the past, at least 5 different times over the past several years, not yet reaching what we're looking to achieve on joint venture structure. We believe with the market now moving in our favor, both in terms of gold and copper price, as well as the obvious need of the big companies to start to find new projects to build because they are running out of reserves, we believe that our time is about to come in securing a joint venture to co-develop KSM. As David mentioned in the beginning, we are dual listed both on the New York Stock Exchange and the Toronto Stock Exchange, although most of our volume is in New York. We are part of the GDXJ and a number of other indices in Canada, including the TSX Composite. Low share count, fully diluted, just under 70 million shares, no debt, decent balance sheet, and very, very strong insider ownership. In fact, insiders and co-founders of this company own over 30% of the common shares outstanding. David, with that, I'd be happy to open it up for questions.
Great. I think
Okay, Rudy,
Thur,
we'll turn to questions.
Mhm.
Right. All right. Let's start with Howie Flinker. Sorry, gentlemen. 1 second.
Howie, you'll have to, there you go.
Am I unmuted?
I'm with you. Sorry, I'm back.
You are
sorry.
indeed.
Okay.
What?
I'm current on Seabridge, but I want to add something to what the previous fellow said about money. According to the St. Louis Fed, the velocity of money collapsed. It's on their site. Collapsed in the second quarter, the worst it's ever done in 60 years. They only have a 60-year database displayed. So to put it in perspective, for the last 15 years, it had been creeping downward from, say, a level of 2 to about a level of 140. The different M's differ slightly. In the second quarter, it dropped 20 or 30% on its own. That has never happened. At some point, as people come out of their caves, they're going to spend a little more. They're not going to keep spending less than $1 that comes in. This is the first time in 60 years that the velocity has been below 1. When that happens, it's probably going to show up in modest inflation. So that just adds to what the fellow said. I doubt that it's going to keep collapsing. You know, people will adjust and, you know, they'll buy 2 oranges instead of 1. I just wanted to add that.
Yep, you're right.
Thanks, Howie.
Welcome, Rudy. Hi, Rudy.
Okay, we'll turn to John Bowen, please. John is muted.
John, you'll have to unmute yourself.
Let's turn to Murray, please, or Martin DeBovis. Martin, let's start with Martin.
It's really exciting project. I mean, you seem to be very wealthy in assets. What percentage of production do you have going on right now that you think of potential production?
Well, it's not producing now, obviously, but when built, it'll produce a lot of metal for decades. You know, our goal in a joint venture, if that's the question, is to hang on to at least 30% of this project, while perhaps committing less than 10% of the project's capital towards the back end of construction. If you look at the project today, the first 10 years of mine life at today's copper and gold price will generate over $2 billion of cash flow annually. So a 30% interest in $2 billion of cash flow is $600 million. Our goal in a joint venture would be to take back our share of the project cash flow in terms of physical gold, which can be done in a joint venture structure. Our whole focus is turning cash into gold. And if we can take back physical gold flow from this project, whatever share we're able to maintain in a joint venture, we can perhaps find a way to dividend out that gold to our shareholders in some physical form.
Very interesting. Thank you. Really interesting.
You're welcome.
Turn to Murray.
I think we may have John. John, do you hear us?
Hey, can you hear me?
We can, yes.
Okay.
Okay, Rudy, congratulations on all
Yeah,
you've
so
done.
we lay that out for you and how you,
I'm curious how, when you're negotiating with these prospective partners, what's their outlook on metals prices? Have they decided that they're bullish, or are they still thinking we've got to make this work on $1,200 gold?
Well, I think for the gold companies, they tend to be a conservative lot. So they tend to, make sure that they have, that the projects can make money at lower gold prices than you're trading at today. And if you in fact even talk to, listen to some of the presentations, they're still doing their reserves at $1,300 or $1,400 gold, which is fine because our project actually does quite well even at that gold price environment. But they will also run scenarios, obviously, at much higher gold prices, just to show the bandwidth that a project might have like this.
Oh, how much spread is there between their thinking and your thinking?
Well, our thinking isn't really focused on the gold price. It's really focused on keeping a significant interest in the project, but not having to come up with a lot of capital. I mean, you've been following us for years. You know how tight we are with our shares. We'd like to limit our dilution down the road for whatever capital we might have to contribute. And we'd like to have our capital go in at the back end. So we're doing it at a much higher share price than we are today. As you would imagine, as this project gets closer and closer to delivering metals and cash flow, our share price should continue to go higher and higher. So if we have to fund our portion of capital at the back end, it will be, in our belief, a much higher share price than if we had to, fund it on the front end.
Okay, thanks.
thanks so much. We're going to turn to Nick Polidris. Nick's got to unmute. He's
Can you hear me?
Here he is. Thanks, Nick. Good to have you on the call.
Okay.
Question today, Nick?
Yeah, just want to say excellent presentation. Just keep up the good work. Thank you.
That was too easy, Nick. Thank you.
It's always nice. Did we get Howie? Howie? Is he?
I think I'm on. Murray's on now.
Yep,
Oh, I'm
Murray.
sorry, Murray. All you. I'm sorry.
Rudy, agree with the other people. Thanks. Always love hearing the updates. And I wanted to compliment you. You've talked now for a year or so that we get the updated in a PEA, and it really is impressive. It's quite a bit better than I thought it might be. So I'm happy for that. But the other thing is, can you comment generally on your thoughts now on the Golden Triangle? Everybody wants to be in the Golden Triangle. Anybody that's got any turf there claims they've got a bonanza. And you probably got more experience there than anybody else. And I'm just wondering what your general comments might be about that.
Well, obviously, it's a district that is having a lot of fines. You have ourselves there. You have Pretium next door that has now built a successful mine. To the north of us at Galore Creek, you have Teck and Newmont in a joint venture. You have Teck solely owning Shaft Creek. You have GT Gold there that now seems to be funded by Newmont to a certain extent on their exploration activities. And then you have the producing mine there, Red Chris, where Newcrest came in a couple of years ago and bought a 70% interest in that producing mine for $800 million in cash. I mean, clearly the amount of metal that's being found, has already been found here, is remarkable. What I will say is, since we were one of the first people in there, we actually acquired our ground before Pretium did theirs from Silver Standard. We had a look at everything up there. One of the acquisitions we did do was Iskit, after looking around, determining that's an asset we want to own. I mean, there's no question that juniors love to follow where the success is, with the belief that where there is smoke, there's fire. And there will be more discoveries made there. There's no question about that. But whether they lead to mines or not is another question. A lot of dollars go into the ground drilling targets that never become mines. So we'll just have to see. The other thing I would point out is that the timelines that are required to take a project from discovery announcing your initial resource, doing the engineering work on that resources, doing the infill drilling so you can get to reserves, doing the design for mines in terms of where you're going to put your waste rock, where you're going to put your tailings. These things have to be thought from the beginning, because without those elements, you're not going to have a successful project, even if you find a deposit. So I think a lot of companies just go in for the drilling, generating news, they're drilling for the next financing, whereas you really need to think how you're going to take a project from discovery through engineering and then through permitting. In our case, if you look at our timeline, we made our first discovery at KSM at the Mitchell Zone in 2006. It wasn't until 2014 that we actually had an approved project. That was 8 years of work where we spent hundreds of millions of dollars to get to that. It's the long road to take a project from exploration into a potential producing mine. And a lot of companies don't do the necessary work up front to get to that point.
Thanks for that. Lastly, snowfields. I've always been fascinated by the close proximity and wondering whether there was some synergy that you guys could do early on. Now, obviously with Iron Cap, you don't need to, but can you just comment on your thoughts on Snowfield at this point?
I mean, Snowfield was an interesting potential add-on to KSM. We actually did some studies early on with Pretium that was publicly disclosed, looking at how Snowfield might fit into the greater KSM. It does have that possibility, but again, we've taken KSM so far now through permitting that, and also with significant additions since we did that study in 2011. So I think we probably have to start all over in terms of how that might fit in. And then of course, what you might have to pay to get it into the greater KSM. You know, Pretium has done a great job in terms of advancing their Brucejack project. The last quarter that they announced their results on was remarkable and obviously well received in the marketplace. But when you look at what we have on our side of the border and what Pretium has on their side of the border, we have more gold between us than exists on the Carlin Trend or was ever mined on the Carlin Trend. And just to put that into perspective, I mean, this is a major district that is going to become, it's going to have a lot of mines as we go forward. And between ourselves and Pretium, we've got the bulk of the reserves and resources so far in the Golden Triangle.
Thank you very much.
You're welcome.
Thanks, Murray. Always a pleasure having you on the call. Howie have a question today? We'll just go back to him one, and then we have audience. Howie,
David, I spoke.
Yeah, we heard from Howie already. So did you have another follow-up, Howie, or are you?
I saw him unmuted. He's good? Okay, I saw him unmuted. I thought he wanted another question. Okay, let's turn. Scott has some questions from the attendees.
I do indeed. Quite a few. So let me start at the beginning. This is a question for Rudy. What base case for gold's price shapes the thinking of your prospective JV partners, e.g. 1,200, 1,500? I assume it isn't the current market level or higher. And what price shapes your thinking as you negotiate?
Well, you know, if you look at what the majors are using now for their gold price assumptions and reserves, you know, that's what they'll probably be focusing on. So that probably puts it about $1,400 to $1,500 today. You know, it's interesting that the gold companies, they have gold and backwardation in terms of prices going forward, but they're comfortable using a $3 copper price for copper, which is slightly above spot today. So, you know, and so, you know, when we show our project, tremendous economic potential, unbelievable financial metrics at gold prices less than $1,500 and copper prices less than $3. So I don't think the metal price is that big of an issue anymore, especially with what it's done over the past few months.
Thank you. Okay, this one is quite a bit long, but in a previous investor webinar earlier this summer, you were asked about whether or not you would need Tudor Gold's permission to build the Mitchell Treaty tunnels through the Treaty Creek property. And then there was some discussion about whether you would need an agreement with Tudor Gold to do that, with or without an agreement. Can you provide a more definitive answer as to Seabridge's existing rights and potential problems if a major deposit is defined at Treaty Creek?
Well, so far there hasn't been a deposit defined at Treaty Creek. I know they've done a lot of drilling there. They've talked about a resource estimate for years now and have not delivered on it. If they do deliver a resource estimate that would impact the tunnels, we'll sit down as good neighbors and discuss. Right now, we have a license of occupation that was granted by the government that gives us the tunnel rights for the project through their ground. We have permits in place to actually start building the portals, as well as the first several hundred meters from each portal. We are not going to stand in the way of someone else's discovery. Fortunately, there is flexibility if needed, where we can tweak the tunnel route without changing the portals to avoid any economic deposits that they have. But again, they have not defined any economic deposits. They have not defined any resources yet. And until they do, it's premature for us to sit down and discuss changing the tunnel route when we now have that license of occupation already granted.
That makes a lot of sense. Thank you. The next question, would you like to hang on to 3 aces, or is everything for sale? Do you see the Eskay Creek interest by majors moving north to the Yukon?
Until we do work on it ourselves, we have to do that work to decide whether it's going to be a core asset or a non-core asset. You look at our track record over the past 21 years, at certain points in times, we're willing to sell non-core assets as a way of generating proceeds to fund our core assets. It's too early yet to determine whether 3 aces is a core asset or not. But what I will tell you, looking at the work that's been done to date, it is fascinating to see that type of grade right at the surface on a system that appears that big. So I like our chances for 3 aces to become a significant asset for us, but more work has to be done to get us there.
Thank you. This question is, I wonder about Seabridge's views on debt funding.
We don't like debt. We've now managed the company for 21 years with no debt. We don't intend to take on any debt soon. Debt could be a way, though, to fund a portion of what our capital contribution might be for KSM. Fortunately, our view is that we will do that funding towards the back end of construction, so we have a lot of time to figure out how much debt we may want to take on, if any, for that. I'm not debt adverse as long as it doesn't put any limits on in terms of gold pricing. I am not a fan of hedging, and I would never intend to raise debt for Seabridge that has any hedging involved with it.
Thank you. The last 2 I have are, the first one is, what are the factors that seem to be holding some of the bigger companies back, even in this environment? And do you ever foresee developing KSM on your own?
We will never build this mine on our own. We recognize that there's a very limited number of companies that have the technical, the financial, and the social wherewithal to build mines of the scale. We're not one of them. In fact, we see it as 7 companies or less. What was the first part of that question again?
So yeah, let me get back to it, sorry. What are some of the factors holding back some of the bigger companies, even in this environment, I guess from a JV perspective?
Well, we have had offers. It's not like they haven't made offers to us yet. We just have not yet received the right offer from the right partner. I think if you look at the majors, they tend to obsess at turning gold into cash and losing money at it by the end of the day. They tend to do their acquisitions at market tops, and then as they take on too much debt to do their acquisitions, as the market goes down, they're selling non-core assets. I think for the first time in a long time, the majors now have at least cleaned up their balance sheets from the mistakes they made at previous tops. It's amazing how much debt the industry took on in 2010 and 2011. They've cleaned things up now. And I think the elephant in the room that nobody is really focusing on yet is the dwindling reserves that the major mining companies have, especially on the gold side. If you look at the gold industry as a whole, the gold industry today has only 11 years of reserves left to mine before they run out. They need to start thinking about their futures. We believe they're going to be focusing on large-scale projects like KSM, projects that can and have been permitted like KSM, and projects that have capital efficiency like KSM, and projects that have done a good job in terms of obtaining social license like we have at KSM. So when we look at what's maybe available to the majors as they now move to look forward and replace their cupboards, we like our chances.
Rudy, I have a question. It's David Mandy. Most of the majors don't have much of exploration groups, do they? I mean, it seems like, haven't they pretty much gutted their exploration?
Well, they still seem to spend a lot of money on it and not very successful. I think I saw one statistic here recently where the finding cost of the majors is north of $100 an ounce. Our finding cost at KSM was less than $2 an ounce.
Yeah,
They
that
spend
says
a
it
lot of
all.
money, but they're not very good at it, which is why they always have to turn to the market to find new assets.
Yeah.
Yeah,
that
Rudy,
makes
I could also mention that Minex just came out with a number that indicates exploration spending by the industry is down 63% from its top in 2012. It's down to 4 billion. So you're right, they're not very efficient at it, but also they are spending less.
Yeah, they're spending on. Great ones are at companies like Seabridge.
That's right.
Scott, further
So
questions?
yeah, that was it from the field. I do have one question for sure that I'm just going to get to you, Rudy, outside of the webinar, and you can get an answer back because it's quite detailed. But that's great questions from the audience. We always thank everyone. If there's anything else, please send it in quick before we wrap. But I think we've gotten them.
Terrific.
Okay.
Back
Well,
to
thanks
you, Rudy.
everyone. And we are always open to answer questions if you'd like to come to us directly. You can reach out to me at my email, Rudy, R-U-D-I, @seabridgegold.net. And when you email me a question, put your phone number in as well. I'd much rather call you back than just type an answer. So David, appreciate the effort again. We've been working together for 15 years now, and you've done a great job for us in the past. And I look forward to continuing these calls with you as we go forward. Although it would be nice at some point in the not too distant future to be able to go in front of a room with people faces versus just a computer screen. So hopefully
Right.
we will come again soon.
Exactly. If on that note, I'm going to give you a quick call. Okay, Rudy?
Okay. All right. Take
Okay.
care.
I want to wish everyone a pleasant evening, afternoon, and I really thank you for your attendance and participation as always. I wish you well. Bye-bye.